Last week we put out a short video on the Archegos situation and it actually got quite a lot more views than other videos on this channel. So it seems to be one of those topics that's just catching everyone's attention at the moment. I think partly because of the impact it had on the market and also partly just for the shock and intrigue factor. We can't help but rubberneck about it. But for those of you that don't know what's been going on, well, it's been a bit crazy. Welcome to the Archegos saga. Now that details are emerging about what actually went on, let's go through some of the latest developments. So back in 2013, Bill Hwang started his little family office, or at least little by hedge fund standards, with a relatively minor $200 million in capital. But it wasn't so little by this year. He managed to amass a net worth of $20 billion. So that's impressive by anyone's standards, but that was until the end of last month when he started just kindly giving back some of his wealth, although I'm pretty sure that wasn't what his intention was, while simultaneously leaving a big gaping hole in the books of some investment banks. So a few days before his collapse, some banks were already seeing problems with his positions, particularly with his holdings with Viacom. It's reported that some bankers tried to get him to sell some shares and just take a loss, but Bill was all in, literally. So let's be fair here, you don't build that sort of level of wealth without getting some sort of ego that makes you feel invincible, no matter how religious you are, and he very much was.
It's not all about money, but it's about long-term. God certainly has a long-term view.
You still feel like, you could do no wrong if you're amassing that sort of wealth in such a short amount of time. But anyway, emergency meetings were held at prime brokerages that he was dealing with, including some major investment banks. Now, they wanted to shore up some buffer capital and cover the margin, but spoiler alert, it didn't quite work. Instead of managing the damage and selling some of the positions, Bill went on to take one of the biggest losses in financial history over the course of just a few days. Now, Morgan Stanley managed to get ahead of the game. So before the story even hit the markets, they'd managed to hold a fire sale and dumped $5 billion worth of shares.
Sell it all? Yes, but at what cost?
And there's all kinds of rumors about what went on between the different banks and what calls they had and what they agreed and who went against what. It's quite interesting to read about, but since we don't know what actually is fact or fiction, then we're going to leave it out for now. But some other banks didn't get to have the same opportunity to offload their unwanted crap onto their clients, so instead they had to bear the brunt of the losses.
So state of play, you look at Morgan Stanley on one hand, Morgan Stanley really recovering a lot of its losses we saw yesterday, Goldman jumping back well above what it lost yesterday in the stock market. Credit Suisse, Nomura, MUFJ, like you said, there could be anywhere from hundreds of millions of dollars worth of losses to billions of dollars worth of losses.
So for Credit Suisse, that resulted in a $4.7 billion loss. Luckily, they did have strong performance in other areas of their business, so their loss for Q1 comes in at just a minor, measly less than $1 billion. But naturally, some top execs at the company, including the head of investment banking, still got the boot. Now, Nomura is another biggie that got a kick in the balls from all of this with a $2 billion loss, so that's another big one, but those are the two firms that got the biggest hit. There were also others as well, such as Mitsubishi Financial, which could be seeing losses of near $300 million from all of this. But once again, the culprits of this situation, other than greed and ego, were derivatives and leverage. So by late March, Archegos were 5 times levered and maybe even more. It's said to be between 5 and 8. So one of the key things that were being used here by Hwang were total return swaps, which meant that he could take advantage of a regulatory blind spot and gain even more exposure to these assets. So these swaps kind of work like a CFD, where you can make a return without owning the underlying stock. So the main benefits for family offices like Archegos is that they can just leverage up and keep their trades relatively private since they don't own the underlying company. Now, banks will take on this sort of risk for clients because they make a nice few quid from it, and then they'll kind of offset the exposure by buying the underlying shares themselves or hedging in some other way, and they'd also assume that they can sell their exposure to another bank. However, in this situation, it wasn't actually possible. Since the positions were private, it meant that Archegos could have arrangements with multiple banks. So this would mean that banks couldn't sell their exposure since the other banks already had their own exposure as well. So in very basic terms, as the stock price continued to increase, the percentage that Bill Hwang was levered would drop as an overall percentage of his portfolio. and that would therefore allow him to increase his leverage even more. So he was basically just sort of going all in time and time again, which is obviously great when it's working, and it did for a long time. That's how he amassed that great net worth. But then as soon as there's a drop in the price of the stock, even a relatively small drop, that could really just wipe him out, and quite rapidly. And that's exactly what ended up happening. Now, since his capital was pretty much all invested, he wasn't actually able to cover the margin calls, and so his positions got liquidated. Now, as risky as all of this sounds, Archegos didn't actually do anything illegal. Everything they did was allowed to be done. But it could mean now that rules for family offices are about to be tightened and become more in line with other hedge funds, since it's obvious that they could actually create systemic risk.
Credit Suisse is tightening the financing requirements for family offices and hedge funds that use swap agreements. I'm not going to get into the details too much because it is a little weedy, but they're going to what's called dynamic margining from static margining. And the net result of that is the family offices and hedge funds that use swap agreements instead of standard prime brokerage agreements may find themselves posting more collateral to take positions. And as those positions evolve in terms of their underlying risk, concentration, and volatility, and the trades that they undertake may end up being less profitable.
Luckily, so far with this one, it looks like it's just been contained to just being Archegos and those banks that have been affected. But it'll be really interesting now to see how things change in the aftermath of this absolute shocker. But anyway, let me know your thoughts on this situation in the comment section down below. Do hit that like button if you found this one interesting or useful. And also, don't forget to follow Market Movers on social media. The links are all in the description box, so you can come and say hi to the team over here and discuss the crazy events that are going on from one day to the next. It just seems to get crazier and crazier throughout this past year. But until then, see you in the next video. Thanks so much for watching. Take care.